A lot of people talk about buying off-plan versus ready property in Dubai, but hardly anyone shows you what actually happens after you buy. Like, what if you bought a studio off-plan back in 2017? Would you have made a killer profit, or did the guy who bought a ready property walk away with a better profit? I'm not just giving you theories here, I'm showing you two real scenarios using Bloom Tower C in JVC as an example. We are talking numbers, timeline, and exactly how it played out. Whether you're a first-time buyer or looking to invest smartly in 2025, this is a kind of breakdown that will help you to decide for yourself if off-plan or ready properties are better for you. Hey, I'm Samir, and I help investors and buyers make smarter real estate decisions in Dubai. In this video, I will break down off-plan versus ready properties using Bloom Towers in JVC as an example. I will include two real scenarios, numbers, and outcomes over 4 years. Alright, before we dive into the real-life numbers, let's just make sure that we're on the same page with the basics. What exactly is the difference between off-plan and ready property? So off-plan is when you buy a property that has not been built yet. You're basically purchasing based on the floor plan or based on some brochures and the promise of a developer to deliver a unit to you. In most cases, you will pay in stages, something like 10% to book, then 20% during the construction, and maybe the rest at the handover. There are many payment plans configurations available to suit your needs, some more attractive than others. It's super popular in Dubai because developers offer flexible payment plans and lower the entry price compared to the ready units. The idea is that you locked in today's price, and by the time the property is complete, maybe in 2, 3, 4 years, its market value has ideally gone up. Sounds great, right? But the catch is, you are betting on the future. Nobody knows how the market will behave until your construction is complete. You cannot move in, you cannot rent out until the property is finished. And there is always the risk of a delay or the final product not matching your expectations. Now, ready properties are the complete opposite. They are already built, registered with the Dubai Land Department, and you can either move in immediately or start renting them out immediately. What you see is what you get. No waiting, no construction risk, less surprises. But of course, that convenience comes at a price. You will usually pay more upfront and you will not have the same flexible payment options that the developers offer with off-plan deals. You will have to either pay cash or finance with a mortgage. So in a nutshell, off-plan can be a bit cheaper and flexible, but you wait and take more risk. Ready properties are safer and faster, but it costs more upfront. So that's the general idea. But how does this actually play out in the real market? Let's take a look at Bloom Towers and walk through two actual investment paths to see how it all adds up. Now, the project I'm using as an example today isn't just some random development I found online. It's actually one that I've personally invested in. I bought 2 units in Bloom Towers located in Jumeirah Village Circle or JVC. And I've studied myself how this project moved from off-plan all the way to ready. And I thought, what better case study to use than something that I've actually gone through myself. So for some quick context, Bloom Towers is a 3-towers residential project developed by Bloom Holding, a reputable developer originally based out of Abu Dhabi. It launches as an off-plan project back in 2017 and handed over started around late 2020 and early 2021. The location is right on the edge of JVC with easy access to Al Khair Road, and it's been pretty popular with both end users and investors. Mainly because of the affordable price point, the good amenities like the gym, the pool and the working space, and the modern glassy design. Most of the units in Bloom Tower C are studios and one-beds, which in Dubai market are usually easier to rent out, sell and manage. And again, the reason why I picked up Bloom Tower for this video is because I purchased 2 apartments there myself, so I studied very well the off-plan prices, the ready prices, the rental yield, and the different expenses. So now I can break it down for you in a real and practical way. In today's video, we are diving into 2 interesting real estate scenarios. We are focusing on Bloom Tower C, a project that first hit the market as off-plan property back in 2017. Most of the units were handed over by 2021, giving us 4 years of off-plan performance. From 2021 until now, that's another 4 years. We can look at how the same units perform as ready properties. So for our first scenario, we will compare 4 years of performance as off-plan from 2017 to 2021 versus 4 years as ready units from 2021 to 2025 in the exact same building. Imagine this, Investor 1 buys in 2017 and sells in 2021, then Investor 2 buys the same unit in 2021 and sells in 2025. That's the journey we're going to explore. Then in our second scenario, we will try to switch the comparison a bit. This time we will compare 4 years as off-plan investment in Bloom Tower C versus 4 years of owning a ready unit in another building in JVC, but with both purchases happening in the same year, 2017. Let's break it all down and see which strategy performed better. To analyze the data, I downloaded all the sales and rental transactions from the Dubai Land Department website. Just for context, these are considered public data here in Dubai. So I pulled everything together and built a website called Macademy. It's a tool that I use to draw charts and make sense of the data. And by the way, it's free and you can use it too. Now let's take a look at an example. We will select Bloom Tower C. Here you can see the average price per square foot from 2017 to 2025. The blue bar marks the point when the building was completed. So everything on the left side of that is from the off-plan phase, and everything on the right side is from ready property phase. Below that, there is a table with the list of all the transactions that happened in this building. Let's scroll to the earliest ones from 2017. You will notice a few studios units were sold back then for around 380 to 400k. Back to the simulation. Investor 1 bought a studio off-plan in Bloom Tower C in 2017. To calculate the price, we took the average price per square foot for transactions that happened in that building in that year. The average was 1,034 dirham per square foot. Let's use the example of a 380 square foot studio. Based on that data, the unit would have cost approximately 392k in 2017. Now, once we add the Dubai Land Department fees, the trustees fees, the Orkut registration, the total transaction cost comes at about 411k. Now, let's assume that investor 1 used a payment plan, which was quite common for this building. Here is an example of a typical plan. 10% on booking, 15% during the construction, and 75% post-handover. So in our simulation, investor 1 decides to resell the unit just before the handover. That means that he's only paid the first 25% of the total price. So even though the property cost 411k, his actual cash investment was only around 116k. Now let's take a look at operating expenses. Since the property was still under construction, there were no service charges, no maintenance, so the total expenses was zero. What about the income? Again, since the property was not ready, there was no rental income either. Fast forward to 2021, the investor 1 decides to resell. But here's the twist, the average price per square foot went down from 1,034 dirham in 2017 to 957 dirham in 2021. So now, he's selling the unit for around 362k. To complete the sale, he pays the developer the NOC fee, which is about 3k. So the net sale amount he receives is about 360k. Now let's have a look at the profit and loss summary after 4 years of investment. He bought at 411k, sold at 360, so that's approximately 51k of loss. But remember that his actual cash invested was only 116k. So in terms of return on cash invested, that's a loss of 43.9%. Now let's move on to investor number 2. Let's imagine that investor 1 sold his unit to investor 2. So investor 2 buys the same studio for 363k. When we include the DLD fee, the agency commission, the trustee fee, his total transaction cost comes to about 388k. Investor 2 buys the unit with a mortgage, putting down 20% as a down payment. He also pays some bank-related admin fees, which comes to around 3k. So his total cash investment upfront is approximately 80.7k. Now let's have a look at the operating expenses. Since it is a ready property, he has to budget for the service charges, the maintenance, and of course, the monthly mortgage payments. The total expenses over 4 years comes to about 120k. What about the rental income? Investor 2 rents out the unit for 4 years. I took the average rental prices for a studio in Bloom Tower C during those years. He would have earned approximately 150k in rent. Now let's keep in mind that this is a rough estimate. In reality, it is difficult to raise the rent every year due to the tenant protection regulations in Dubai, and there might be vacancies between leases. Also, if the property was rented out as a short-term rental and managed well, the return could have been higher. So again, this is a conservative assumption just for simulation purpose. Also, because investor 2 used a mortgage, he has been gradually repaying the loan, so over 4 years, he would have repaid around 29k dirhams of the principal. That means that in total, he gained about 179k in value from rental income and equity buildup. Now, let's fast forward to 2025. Investor 2 decides to sell the unit. Looking at the most recent transactions in Bloom Tower C, studios are selling for around 1,650 dirham per square foot. That brings the value of his studio to about 627,000 dirhams. After paying the 3K for the NOC to the developer, he walks away with approximately 624,000 dirhams. So now let's break down the profit and loss for the investor number 2. He bought at 388K, spent 120K on the expenses, he received 179K as income, and he sold for 624K. So that gives him a net profit of about 295K. And since his initial cash investment was 80.7K, his cash on cash return is impressive, about 366%. So here is a summary. We have investor 1 and investor 2. Both investors bought the exact same unit. Investor 1 bought off-plan in 2017 and sold after 4 years with a 43.9% loss. Investor 2 bought the unit ready in 2021, rented it and sold it in 2025 with a 366% profit or 295K dirhams. The only major differences? One bought off-plan, the other ready. One bought in 2017 and the other in 2021. And one used a payment plan and the other used a mortgage. But they both held the same unit for the same duration, 4 years. Now let's add a third investor to our comparison. This time, investor 3 also buys a ready property, but he does it back in 2017, just like investor 1. This way, we can directly compare buying off-plan in 2017 versus buying ready in 2017. For this simulation, I selected a building that was already completed in 2017, Plaza Residence in JVC. I noticed that the studio prices there were in the same range as the ones in Broome Tower C. The studio in this building are slightly larger, so in our case we'll use a 420 square foot unit. The average price per square foot in this building in 2017 was around 875 dirhams. That means that our 420 square foot studio would have cost approximately 367,000 dirhams. When we include all the transaction fees, the total purchase cost comes to about 392K. Investor 3 also uses a mortgage and ends up putting in around 81K from his own pocket. Now let's look at the operating expenses. The service charges in this building are a bit higher, likely because the property is a bit older. When we add everything together, including the mortgage payment, Investor 3 would have spent around 126K over 4 years. What about the rental income? Doing the same exercise as before, we estimate that Investor 3 would have earned around 160K in over 4 years. He would also have repaid around 30K dirhams of the mortgage principal. So that gives us a total of 190K dirhams of rental income and equity combined. Now let's fast forward to 2021. Investor 3 decides to resell the unit. And here comes the big surprise. The market in this building dropped sharply. The price per square foot falls from 875 dirhams in 2017 to just 564 dirhams in 2021. So now he can only sell the unit for around 236K. Let's have a look at the profit and loss. He invested 81K from his own money and ended up losing around 95K on the deal. That is a 116% loss of his initial investment. So what does this whole exercise actually shows us? Here are the key takeaways for most investors. Number 1, timing is everything in Dubai real estate. Investor 2 bought at the right moment in 2021 and made a 366% return. Investor 1 bought off-plan in 2017 and lost money. Same unit, same holding period, completely different results, all because of the timing. Number 2, off-plan isn't always riskier than ready. We often hear that off-plan is speculative and ready is faster. But Investor 3 bought a ready property in 2017 and still lost even more money than Investor 1. So really, the risk depends on when and where you buy, just not whether it's off-plan or ready. Number 3, older buildings may struggle more in a declining market. Investor 3's unit in an older building dropped sharply in value, even though it was rented and bringing in income. That shows that capital depreciation can hit older stock faster than newer or off-plan property. Number 4, the leverage makes the heights higher and the lows lower. All 3 investors use leverage through either a mortgage or a payment plan. When the market goes up, leverage multiplies your gains, but when it goes down, it magnifies your loss just as fast. Number 5, a short investment horizon is riskier. Each investor held the unit for only 4 years. In real estate, that's not very long. If the market cycle shifts against you, you may not have time to recover. So if you are investing for the short term, you need to be extra careful about the timing. And number 6, the cash flow isn't enough on its own. Both investor 2 and 3 earn solid rental income and paid down part of their mortgages. But investor 3 still lost money because the value of the property dropped more than the income he made. So always balance rental yield against potential capital risk. Bottom line, whether you go for off-plan or ready properties, do your research, understand the cycle, and invest with both the short-term risk and the long-term potential in mind. If you want to push this exercise further, just take the 2 investors that lost money and try to turn their investment into a profitable one. See what are your options. Maybe holding a bit longer, maybe selling and reinvesting somewhere else, but there are always ways to turn an investment that is not profitable into a profitable one. But that we'll discuss in another video. Thank you for watching. Don't forget to hit the like button and subscribe to my channel. I'll see you in the next video.